Virginia cannabis banking hurdles USDA loan ban risk is not about whether cannabis is legal in Virginia. It's about whether a legal Virginia cannabis business can access federal agricultural financing, and in many cases, it cannot. That sounds like a federal issue, not a state issue, but this is where the consequences begin. Because a dispensary or cultivation facility can be fully compliant under Virginia law, licensed, inspected, operating transparently, and still be disqualified from USDA-backed capital. And that unresolved tension is what we're unpacking today. There's a silent legal question underneath all of this. If Virginia says a business is lawful, why does federal agricultural policy still treat it as prohibited? We'll come back to that. Here's the counterintuitive legal fact. Here's the part that surprises people. Virginia legalized adult-use cannabis possession, and the Commonwealth built a regulated medical cannabis framework. That's accurate. But federal law, specifically under the Controlled Substances Act, still classifies cannabis as a Schedule I substance. Legally true at the federal level, yet operationally destabilizing at the state level. So when the United States Department of Agriculture, administers loans, grants, and rural development funding, it does so under federal classification rules. And this is where outcomes diverge. A Virginia farmer growing soybeans can apply for USDA-backed capital. A Virginia cannabis cultivator, operating legally under state law, generally cannot. It is a structural conflict, not a business failure. And that conflict doesn't stay theoretical. It shapes financing, expansion, and risk. Let's challenge a belief. Many viewers assume the problem is just big banks being cautious. Well, that's part of it. But it goes deeper. Even if a local Virginia bank wants to work with a cannabis business, federal deposit insurance, federal oversight, and federal lending programs complicate that decision. This is where the confusion starts. Because the law says one thing. Enforcement says another. On paper, Virginia recognizes the business in federal lending frameworks. That recognition may not matter. And that creates a second unresolved issue. If USDA-backed loans are unavailable, what replaces them, and at what cost? We'll examine that shortly. Welcome to Norfolk, Virginia Cannabis Hub, where we focus on Virginia-specific cannabis law, local governance, and regulatory clarity, so residents, business owners, and communities understand what the law actually says, not just what headlines suggest. Today we are analyzing Virginia cannabis banking hurdles USDA loan ban risk. This is not investment advice, it is not industry promotion, it is a compliance-focused legal analysis grounded in federal classification, Virginia licensing frameworks, and regional economic impact, particularly in Norfolk and the broader Hampton Roads region. We are examining USDA loan ineligibility, federal state conflict, banking access limitations, economic and public safety implications. We are not discussing how to start a cannabis business. We are not encouraging participation in the industry. This is about regulatory friction, and how that friction affects lawful Virginia entities. Because knowing a business is legal is not the same as understanding its financial constraints. And that distinction matters more than most people realize. Here's the context. Virginia's cannabis policy evolved in stages. Medical cannabis access expanded through statutory reforms passed by the Virginia General Assembly. Adult possession was legalized. Regulatory structures were proposed. Licensing frameworks developed unevenly. At the same time, federal law did not change in parallel. The Controlled Substances Act remained intact. USDA loan programs, including rural development loans and agricultural infrastructure funding, are governed by federal statute and agency policy. So here's the structural tension. A cannabis operation in rural Virginia may meet every state licensing requirement. But if it touches federal agricultural funds, it enters a prohibited category. That sounds straightforward. But the operational reality is more complicated. Because not all USDA programs are identical. Not all applicants are structured the same. And enforcement is often administrative, not criminal. This is where people stop researching, and where financial risk begins. Here's the legal explanation. Under federal law, cannabis remains classified as a Schedule I substance. That classification affects eligibility for federal benefits tied to agriculture, infrastructure, and rural development. The USDA does not ban Virginia cannabis businesses out of discretion. More accurately, eligibility standards tied to federal drug classification exclude them. Let me rephrase that. The USDA does not evaluate whether a Virginia cannabis business is compliant under state law. It evaluates whether the activity is permissible under federal law. And under federal law, it is not. That distinction, state legality versus federal permissibility, is where the denial occurs. Now, here's the secondary complication. Even indirect association with cannabis activity may trigger ineligibility. So if a property financed through USDA funding is later leased to a cannabis operator, that can create compliance exposure. This is where the enforcement loop enters. Not police enforcement. Administrative enforcement. Loan covenants, certification statements, funding eligibility reviews. And this is where the phrase becomes critical. The law says one thing. Enforcement says another. Virginia law may recognize the license. Federal funding compliance may still invalidate the transaction. We'll return to how that plays out in practice. How enforcement works. USDA loan ineligibility does not begin with a raid. It begins with paperwork. Applications require certifications of compliance with federal law. Misrepresentation on those forms can trigger funding denial or repayment obligations. Now, this is where the issue becomes less visible but more consequential. Because many cannabis-adjacent businesses, landlords, equipment vendors, agricultural contractors, may unknowingly create conflicts with federally backed financing. A rural property owner in Hampton Roads could hold a USDA-backed mortgage. If that property is leased to a state-licensed cannabis entity, federal compliance questions emerge. And here again. The law says one thing. Enforcement says another. State approval does not override federal funding conditions. Enforcement in this context means loan default risk, funding clawbacks, administrative investigation, contractual invalidation. Not criminal prosecution, but financial exposure. And that exposure often appears long after the initial transaction. Who this affects? Consumers are affected indirectly. If cannabis businesses face restricted capital access, expansion slows, product pricing changes, and regional access disparities grow. Retailers and cultivators are affected directly. Without USDA-backed agricultural financing, expansion requires private lending, often at significantly higher rates. Some private lenders exceed 20% APR, which constrains profitability and long-term viability. Local governments are affected structurally. Municipal revitalization efforts in Norfolk and Hampton Roads sometimes anticipate cannabis licensing as part of redevelopment strategy. If financing bottlenecks stall build-outs, projected tax revenue and district activation are delayed. Within the medical cannabis framework, pharmaceutical processors and regulated dispensaries must maintain strict compliance. Limited access to traditional credit lines complicates infrastructure investment, equipment procurement, and insurance qualification. Each group experiences a different layer of the same conflict. And none of those layers are visible in a headline that simply says, "Cannabis is legal in Virginia." Now, this is where the conversation shifts. Because many viewers assume the banking hesitation is abstract, just general risk management. It isn't. Large national institutions like Bank of America and Wells Fargo operate under federal oversight structures that still treat cannabis as prohibited activity. Even federally insured credit unions, including institutions the size of Navy Federal Credit Union, must evaluate exposure through a federal compliance lens. And this is where structural fragility becomes visible. After the 2023 collapses of Silicon Valley Bank and Signature Bank, federal regulators tightened scrutiny across high-risk lending categories. Cannabis-adjacent financing, even in fully legal states like Virginia, falls into enhanced risk review. So when people say, why won't banks just lend? They're asking the wrong question. The more accurate question is how federally regulated institutions assess balance sheet exposure tied to a Schedule I classification. And this is where the phrase matters again. The law says one thing. Enforcement says another. Virginia law creates operational legality. Federal financial supervision evaluates systemic risk. Now layer in proposed reform like the Safe Banking Act. Even if passed, implementation would require regulatory guidance, rulemaking, and agency alignment. That doesn't happen overnight. So the unresolved issue isn't whether reform is discussed. It's whether reform, once enacted, immediately changes underwriting behavior, or whether risk committees still move cautiously. And that uncertainty is what shapes capital access in Hampton Roads right now. Why this matters? Public safety is part of this. Cash-heavy businesses create elevated theft risk. Limited banking access increases on-site currency storage. That affects employees, surrounding businesses, and local law enforcement resource allocation. Regulatory clarity matters. When entrepreneurs misunderstand financing limitations, they overleverage personal assets. Homes, savings, personal guarantees. Long-term policy implications matter. If federal-state conflicts persist, Virginia's cannabis industry remains structurally disadvantaged compared to other agricultural sectors. And once precedent forms, particularly through federal agency guidance, reversal becomes slower and more complex. Knowing the rule is not the same as avoiding the consequence. Here's a scenario. Earlier, I mentioned the unresolved tension between state legality and federal financing eligibility. Imagine a licensed Virginia cannabis cultivator in a rural county outside Norfolk. The business seeks infrastructure expansion, greenhouse improvements, irrigation systems, processing equipment. A USDA rural development loan appears to fit the criteria. The applicant is compliant under Virginia law. Licensed. Inspected. Tax registered. Application submitted. Denial issued. Not because of state non-compliance, but because federal classification renders the activity ineligible. Now contrast that with a neighboring agricultural producer growing hemp under federal authorization. USDA eligibility may apply. Same region, similar infrastructure needs, different federal classification outcome. The silent legal question at the beginning. Why does legality not equal eligibility? Becomes clear. Because federal program compliance is tethered to federal drug classification, not state licensing. That small distinction changes everything. Not criminal exposure. Financial viability. And that is where outcomes diverge. Here's what to watch next. Federal legislative efforts such as the Safe Banking Act have been introduced repeatedly in Congress. If federal banking reform advances, it may reduce traditional banking hesitation. But USDA eligibility could require additional administrative reinterpretation. Watch for Federal Rescheduling Decisions. USDA Policy Guidance Updates Virginia State Chartered Banking Proposals. Here's a question to think about. If a business is fully lawful under Virginia statute, should federal agricultural financing remain inaccessible? I'm interested in your perspective. If there are other Virginia cannabis law topics you want analyzed, employment, zoning, federal-state conflict, share those in the comments. Like and subscribe for ongoing Virginia-specific regulatory analysis.